Hey, welcome back to the channel. Today we're going to be taking a look at American Tower, ticker symbol AMT. All right, looking at the 5-year chart, we can see it started off around 140, 150 or so, ran up to a high of about 302 after COVID in about mid-2021. And right now we've been in a decent downtrend for a while now. And right now we're sitting at about 176. So I've looked into American Tower a couple times, really like the company. Valuation was just insane. So it's getting into interesting levels now. And yeah, with that being said, let's go ahead and jump into the investor presentation. All right, so before we go into the earnings presentation, we're going to go into the Q2 second quarter 2023 company overview and just get a good sense for what American Tower actually does and, their business model, what might be threats to them, and what might be tailwinds to them. All right, here we get a nice overview of what AMT actually does, and that is they usually buy or long-term lease out land and put towers on them that will be used by either cell companies for cellular equipment, antennas, or even microwave dishes. So, and microwave might be data carriers. It kind of depends on the reasoning, the engineering, what they're building out for. And then they also lease out fiber that they own as part of these leasing agreements to these cell sites or the tower sites. Typically, the only thing that AMT really owns or cares about is the land and the tower itself. All of the ancillary equipment, including these kind of like pods where the leasers might occupy with their equipment, routers, switches, fiber communications equipment. Those are going to be the tenants. The tenants are also going to be in charge of basically any antennas. And then it basically scales out fairly well where you can have one tenant, two tenant, three tenants. I'm guessing, depending on the tower size, you can probably have a lot more tenants too. But as they scale out these towers and onboard more and more customers, more tenants, their profitability is going to go up pretty drastically. We can see that here with the return on investment. For one tenant is about 3%, two tenants is 13%, three tenants is 24%. So it's a nice, pretty exponential growth in profitability. Once they get their first tenant on and then their second and their third, their profitability increases pretty drastically with every time they add on additional tenants. And in this slide, we can see their kind of global diversification, about 226,000 communication sites. The large ones are going to be the US, 43,000. We've got India with 78,000 almost. Let's see. Brazil, 22,800. We have Germany with 14.8 thousand. Spain with 11.8 thousand. So those are some of the big hitters as far as their diversification across these different regions. Pretty nice global geographical diversification here. And each one of these markets is going to have probably their own little nuances. I think it's going to kind of be interesting as we see more and more geographical areas kind of build out their cellular infrastructure. And usually what will happen is it'll start with, basic communications, and then they'll adopt, maybe 4G, 5G quicker. And it will be used more as like a kind of data service provider. And here we get a brief overview of their tower fixed cost profile, ground rent monitoring, insurance, real estate taxes, utilities, site maintenance, and it looks like some of these are also passed through to tenants in certain areas. It looks like in international markets specifically, pass-through items can include ground rent, power, fuel costs, depending on market and structure. So this is going to be pretty low maintenance for like a REIT. It's going to be like pretty much triple net. They're just leasing out the space on the tower and probably providing basic services that are required for these carriers and ISPs to function. And then here we get a sense for kind of how low cost these sites really are. Capital improvements, historical levels of approximately 500 to 800 and approximately 1200 to 1700 per site per year. So yeah, it's not costing a lot to just maintain these sites. Most of the large cost is going to be when they're doing larger projects like redevelopment, increasing tower heights and such. So redevelopment is usually going to be because, they can actually onload more tenants and services and get a better ROI on that space. So redevelopment is usually going to be a good thing long term as they build out that tower and get more tenants on it and improve their ROI on that space. And then they note that long-term drivers include growing wireless penetration for voice networks, 4G, 5G network deployments, and then additional spectrum auctions. So basically more spectrum becoming available, which allows the carriers to deploy that spectrum onto towers with new antennas. And then they note that total mobile connected devices in the US is supposed to grow by about, 7% CAGR from 2023 to 2028. So pretty good underlying growth. And yeah, I would imagine, in the US specifically, we're probably going to see a continuation of higher IoT demand. Internet of Things. So we have IoT, non-IoT, and yeah, you can see the exactly. The IoT demand is 13% growth, with the non-IoT would be 1%. So IoT could be a nice long-term path for growth for carriers and for driving additional data usage, additional demand from these carriers, and that would be basically increased demand for towers and expansion of their networks, and better for AMT and other tower providers. And this is interesting because then we see that non-IoT is going to be the major data drivers, data growth drivers, and IoT is going to be pretty small overall. So this is kind of interesting because it leads me to say okay, well, the non-IoT data drivers, those are going to be regular phones or a internet service being provided by these telcos. But all of those are not, most of that data growth is not going to be a tailwind to tower growth. That's most likely going to be a tailwind to small cell deployment. To increase the capacity for those higher data usage devices and kind of internet offerings, like T-Mobile's internet offerings. I think AT&T has 5G internet now, where you can basically just get a router at your house, hook it in with a modem, and you have 5G internet to your house. So a lot of this non-IoT data usage growth is not really going to be beneficial, in my opinion, to the tower business. It's mostly going to be beneficial to the small cell business as they're deploying a denser network on that mid and high band spectrum. And then again, we get kind of the data usage for common activities by cell phones, which a lot of this, like Netflix, Hulu, YouTube, Facebook, a lot of the data heavy drivers, they're it's funny because they're presenting this like it's a good thing, but it's most likely going to buy or benefit the companies that are providing small cell sites the most, not really these tower sites. So I don't know. It's a good tailwind for the overall industry, but those deployments are most likely going to go to high capacity small cell sites. So I don't know. And again, data traffic growth. So yeah, I'm not buying that data traffic growth is good for AMT. It is in some cases, but a lot of the really data heavy applications and these wireless carriers building out their small cell coverage to be able to really provide the amount of data needed for their users, that's not going on a tower. So it's funny that they're kind of pounding this over and over again. All right, so here we can see that they're just kind of touting that smartphones in international or lower economic regions are coming down drastically in price, kind of giving them similar functionality to what we have in the United States. And yeah, that is, I think, going to be really good tailwind for them, especially as those areas are probably going to be focused more on towers and potentially lower throughputs, so not as focused on small cells, and kind of growing that way. All right, and then they just show some historical data, so as far as their growth and whatnot. So, but hey, history only matters for the past. So we'll see what we can find if they have any guidance going forward. I think they were kind of, I'll have to verify this, but I think they were kind of guiding for nominal growth of about like 7 to 8% going forward. Let me see if I can verify that though. All right, yes. So raising 2023 organic tenant billing growth. This is in their earnings presentation. And yeah, they note 6.5%. So yeah, for 2023, we're looking at 6.5% growth. Their earnings presentation is basically just going over their financial results for Q2, but we will go look at that in the spreadsheet when we go and look over all the financial metrics. All right, if we go into the earnings transcript, we can see basically analysts just asking about kind of their guidance of growing 5% organically beyond 2023. That's kind of what they've told investors before, that, you know, for the next 5 years, I think it was 2023 to 2028, they kind of assume that they will be able to grow organically at about a 5% number. We can see the CFO's response was, yeah, they expect their 5% target to remain for the US from now until 2027. And the reference slowdown by the analyst that was asking the question, they don't think it's going to affect their forward-looking guidance. But this 5% organic growth wouldn't account really for new development or anything like that. So yeah, it'll be interesting to see what type of long-term runway they have with new development alongside their organic growth. Probably say 5% organic growth, maybe like another 3 or 4% from new builds that could potentially happen. It'll be kind of interesting. If that 5% includes like new builds and everything they have in their pipeline, then I would be a little bit worried. I think this 5% just refers to the tenant billings that they currently have though. One thing that I did want to mention real quick is that I don't know if anybody else, or I'm sure other people have seen this, but T-Mobile recently did a partnership with SpaceX to launch a satellite, and it would kind of, I think it would kind of be launched with Starlink. Leveraging Starlink, and it would basically be used for emergency communications. Well, not even emergency communications, but being able to have access to SMS, MMS, so like texting, pictures, stuff like that, basic communications outside of normal coverage areas. And that's pretty dang sweet. So this would not rely on any towers or anything like that. It would just be part of kind of the Starlink constellation. And the one risk that would be huge in the tower industry is if this type of technology advanced enough to where it could provide similar basic cell coverage from a low Earth orbit, a LEO satellite constellation such as Starlink. Because if they could do that, and they could provide low Earth orbit cell service that had decent, reach and penetration through walls and stuff like that, which is a whole nother discussion. I think it's very low probability that they'll be able to, but if they do, then look out for the tower industry, because it's just going to be a madhouse. Any type of narrative where something like that happens and they think they can offload this to a lot of like LEO satellite services, I don't know if it'd be cost effective, but I could see it kind of freaking out the tower REIT market a lot. Now, that would not probably jeopardize companies that are really into small cells or have high small cell exposure, because most likely they're probably not going to be able to provide the capacity and the throughput that small cell mid and high band 5G would be able to provide. All right, so getting into the income statement here, we can see the last 10 years of growth for AMT. They've been really steady, really good. They've had really good revenue, net income, operating income growth. Some increases in depreciation and amortization, which is totally expected, especially with this being like a REIT. Operating expenses increased pretty steadily alongside it. Great EPS diluted increased growth over the last 10 years, and weighted average shares outstanding diluted pretty flat. So some dilution, not much. We'll see going over the balance sheet that they mostly grow by reinvestment of capital and by raising debts. So we can see a total assets, obviously a ton, because they have a lot of towers, 220,000, right? So total assets, way up there at like 66 billion. Is that? Jeez, that's a lot. Total liabilities or total current liabilities, about 6.9 billion. Short-term cash and cash equivalents at about 2 billion. Long-term debt right now is sitting at about 43 billion. And yeah, we can see a decent amount of long-term debt growth as they have grown the company. So they are raising that capital and via debt instead of dilution for those new builds. Goodwill and intangible assets, yeah, not too bad. Tangible assets about 17 billion. Goodwill about 13 billion. So decent amount of goodwill and intangible assets actually on the balance sheet. Going over to free cash flow statement, we can see operating cash flow increased nicely throughout the last 10 years. Stock-based compensation is basically non-existent. As we saw previously, their share count is increasing very slowly. You see capital expenditure, depreciation and amortization is very high, which is to be expected. Then we have, let's see, most of their cash flows is going towards debt repayment and dividends, right? So, which is also to be expected. Usually REITs, their biggest cash flow or cash outflows from their free cash flow or their operating cash flow is going to be to debt repayment and dividends paid. So decent free cash flow growth through there. And let's go ahead and go over the ratios and metrics. Pretty steady gross profit margins, hanging around 70%. Recently, they did have a quick decline, and then a recovery in net profit margin and operating profit margin. So operating profit margin right now is sitting at about 31.5%, and it looks like it might have downtrended a little bit over the years. Net profit margin about 17.16%. Operating cash flow per share has increased nicely, but you can kind of see like the operating cash flow per share hasn't really done much. Well, I'm sure it's gonna, let's say it recovers back to this 2021 standard, and yeah, so it's kind of been flat. They went through some growth, kind of been flat. Maybe we'll see more operating cash flow growth here in the next couple of years, kind of resume trend line, but I don't know. It's kind of strange. Enterprise value versus market cap. You can see market cap has dipped a decent amount, but their debt load has also increased, so their enterprise value is still probably around the same enterprise value as true 2020 right now. So even though their market cap is down pretty significantly, their enterprise value is pretty flat over the last couple of years. Historical dividend payouts, we can see they have been steadily growing that dividend. We've got EBIT, net income, operating cash flow. We see the growth year by year. We can kind of see up to year to date or previous 12 months, operating cash flow is about 43.97 compared to 5 years ago, 37.48. So like a little bit of growth, not like a ton though. Net income, dividends paid, operating cash flow in this chart, and we have about operating cash flow of 3.6 billion over last in 2022, and then about 2.6 billion paid out in dividends paid. So net income obviously way lower than operating cash flow because they're depreciating a lot of assets. Operating cash flow per share and dividend ratio over the last 10 years. Operating cash flow per share is actually surprisingly down. It's down over the last, that's for 2022. So 2023 is going to be higher. I don't think I have the last 12 months in this chart. So looking at 2022, it's down compared to 2018. And the dividend operating cash flow ratio is about 71%, so fairly high. They've grown their dividend consistently, but they've grown it with by increasing the payout ratio as well. Back in 2016, the payout ratio was about 36.74%, and now, or at least in 2022, the payout ratio is 71%. 2021, it was 47%. So looks like they're keeping that dividend ratio up. Let's look at their interest expenses to operating cash flow. You can see they have a decent amount of interest expenses to their cash flow, operating cash flow to total debt, and they're pretty highly levered. Wow, man, 2022 interest expense ratio to operating cash flow was 30.75%. That's really high. 30% of their operating cash flow was taken up by interest expenses. So you really need to look at their debt structure and see how much debt they might have to be rolling over. That could get nasty. That could get really nasty. Yeah, I don't know, that's pretty high. I wonder what this is compared to like CCI. They are about 30%, 0.7% cash flow coverage ratio, which cash flow equals 7% of their total debt. Let's look at CCI real quick. All right, and then this is CCI, and they're at about 24, so they have a lower interest expense ratio for 2022, and they have a better cash flow coverage ratio, about 10.2% instead of 7 or 8% that AMT had. So they actually look like they're in a better position, and this is the one that's hated more. Market doesn't like this one right now because of the sprint runoff that they're having, and the uncertainty in small cells going forward, and how those kind of business economics are gonna actually play out, how profitable they're gonna be. So yeah, interesting. Let's pull AMT back up. All right, we got AMT back up, and I think we're probably good. We could go through some growth percentages. Dividend growth about 13% last year. So dividend growth has been good, but I would, as we saw previously, their dividend payout ratio compared to their operating cash flow was steadily increasing. So they're kind of just eating more and more that cash flow and their dividend. So that's kind of meh. All right, well, let's go ahead and jump into the valuation template. All right, we got the REIT template up here. Let's go ahead and see historically what they have done as far as how the market's kind of priced them yields wise. And we're really gonna focus just on operating cash flow yield right now, because they have so much that they're depreciating out that net income and EBIT probably isn't going to be a good indicator of how the market is actually pricing or valuing their cash flows, because operating cash flow or really AFFO or FFO is going to be the best metric for that. Operating cash flow is what I'm using because that's what I have access to via my API. So you see that operating cash flow yield over the last 10 years has kind of hovered between 6% down to maybe about 3.6-ish or so. Yeah, 3.65%. So for the valuation, I think I'm going to use probably around 3.5% best case scenario, and probably about 6.5 in the worst case. So real quick, going over some growth numbers over the last 5 years, we can see operating cash flow growth was about 4.79% average over the last 5 years. Net growth was about 7.34. EBIT growth was about 6.5. I believe that's going off of the 2022 finalized numbers. So if we take into account, let's see, probably 2023, it might be a bit better. But really we're looking at about 4.79 operating cash flow growth, which kind of lines up with their 5% organic growth estimate. And yeah, so that's looking like probably a good growth number to use going forward. All right, so for the valuation, we're not normalizing. We're doing operating cash flow only. We have a target rate of 12.5% plus a 3.49% dividend. So that's going to give us, about a 16% target rate. And you know what? Let's change that to a 15% target rate. So we're going to do 9%. That should be about a 15% target rate. So over the operating cash flow yield spread, what I did was I bumped it down and put the kind of growth scenarios to where we got scenarios between 3.58% on the multiple for the bottom line fair value yield. That's in the kind of the best case scenario, 3.58%, to a worst case scenario of 6.52%. So we kind of took that range that we saw previously over the last 10 years, added a little bit of buffer on each end, and it went from there. For the dilution, we have about 1.4% dilution in the best case scenario, 2.05% dilution in the worst case scenario. The bottom line growth, which was really going to be the operating cash flow growth, we have about 6.21% in the best case scenario to 4.26% in the worst case scenario. And that 5.14% is kind of our base case midpoint, and that's the one that I have like a 50% probability of happening. How I lay out these scenarios is scenario 3 is always kind of my base case, what I think is the most probable in happening, and then the lower scenarios are going to be like kind of worse, more like worst case scenarios, and the upper scenarios are going to be better case scenarios. So just give us a spread of kind of where the value is across those different scenarios. So you can see here that the bottom line fair value yields 3.58 to 6.25. And with our target of that 11.5% target rate, with the 3.5% dividend, giving about a 15% target KGAR, we get the scenario 1 buy price of $97, scenario 2 buy price of $116, scenario 3 of basically $140, scenario 4 of $166, scenario 5 of $198. So basically, we're right in line with scenario 5 right now. I wonder what would happen if I normalize this, because this essentially is taking operating cash flow in the base case. We'll see. It's taking operating cash flow in the base case up to about 5.6 billion after 5 years. And maybe that's a little bit low. Maybe that should be closer to 6, which, I mean, we could up the growth a little bit. If we do up the growth, say 2 percentage points, we do a spread from like 5.63 to 8.2. Yeah, we're gonna get closer to about 150 on the base case, and that would bring our let's see, operating cash flow to about 6 billion at the end of the 5-year period in the base case. So base case would be about 150 right there. I don't know if, see, the problem is that American Tower at this point is so mature, they're already everywhere, that I'm not sure how much net new growth they would have other than just like leasing renewal growth and stuff like that. So I think this is the safer scenario. I think if we did do a buffer and like said, oh, in the best case, they might be able to do 8.21, then we would have to increase the spread quite a bit and say that our spread is going to be probably like -20 or -15. And yeah, that would give us probably kind of a base scenario of 144. We would already be in the one of the better scenarios for an entry. And yeah, let's do that. So we have 4.29 to 8.21. I like that spread better, honestly. Still gives us a pretty good base scenario of about 6% operating cash flow growth. I think that's probably a little bit more realistic. In that case, our scenario would be 97, scenario 1 for the buy price. Scenario 2 would be 118, scenario 3 would be 144, scenario 4 would be 177, scenario 5 would be 218. So we're getting close. We're getting in that realm of reason, right? We're at like 176 right now. Yeah, 176.45. So we're getting there. We're getting close. 5-year targets based off of these. In the bearish scenario, or not bearish, but in scenario 1, 5-year target would be 162. So actually a little bit of downside from here. Scenario 2 would be about 197. A little bit of growth. Scenario 3 would be 241. Scenario 4 would be 295. Scenario 5 would be 363 for the 5-year targets. And then for returns in those hypothetical scenarios, now this would not include dividends. So this is just equities price only returns. You'd have to figure in returns of dividends on top of that. So equity price only returns over 5 years in the lower case would be about negative 1.64%. In this scenario 2 would be 2.3% average KGAR. Scenario 3 would be 6.45% KGAR. Scenario 4 would be 10.86% KGAR, and scenario 5 would be 15.57% KGAR. So, but those do not include dividends. So after taking into account dividends, you would be pretty much green on all of these. But yeah, so AMT looking interesting. It's looking a lot more reasonable. I think it could get into some better areas of opportunity, especially if we get any type of negative sentiment, or if the negative momentum continues on with this one. It was one that was just priced like perfect for a while, so I'm glad it's pulling back. It's getting into a more reasonable area. If we get that operating cash flow yield up towards about 6%, that starts to become pretty interesting. That's probably going to take us in between our scenario 2 and scenario 3. And that's kind of, that's a much fairer price, in my opinion, for AMT. So, hope you guys enjoyed this. Hope you had a great weekend, and should be doing a live stream tomorrow. So hope to see you there, and we'll catch you later. As always, this is not financial advice. This is just my musings and looking over another company. So do your own research, your own valuation, everything, and do not, buy or sell or do anything based off of a guy, on YouTube.